So what is the cost of an option? The total cost of an option is the premium, which is influenced by several factors known as the Greeks. The premium is determined by factors including the stock price, the futures price, or the price of the underlying, which is considered the delta. Now, delta of an option, it can change. So it's constantly moving, whether it's in the money or out of the money. But something to think about here, an option that is at the money usually has a delta of 0.5, which means for every dollar change in that underlying asset, ABC stocks, every time ABC stock at the money, our strike is at the money, 50 is the underlying, 50 is the strike. If ABC stock rises to $51, then our options price will go up by 50 cents, right? So that is what delta is. Delta is basically the change in the price versus the price of the underlying stock. The volatility is vega. So remember, volatility is an approximation of how much the option price will change given 1% more in implied volatility. Now, we talked about it a little bit earlier when you bought a stock right in front of earnings. Well, that volatility is usually the highest right before a binary event. So they're pumping it up. They're pumping up the volatility because they expect there to be a big change. So volatility can compress, and that's going to cause the price of that option to also go down in value. So you could be directionally right, but you didn't take account volatility or the implied volatility or the implied volatility rank of that particular option. Implied volatility is what the overall change in volatility for that particular underlying is. Implied volatility rank is if this stock is usually very volatile, it's going to kind of average itself out. Implied volatility rank will denote when it's outside of the normal distribution, so to speak. And theta is the time remaining to expiration. Theta will rapidly decrease the value of the options premium the closer we get to expiration. About 30 days you'll start to see that options premium start to tank. And usually that's going to be related to theta. Volatility has to do with the market, whether the market's very volatile. So think volatility, vega, time, theta. VV, Pretty simple so far. A couple of other ones that get a little bit more technical, more involved, but for these purposes and basic options, gamma is the change in delta. So as delta goes from 50 to 55, gamma would be 5 in that instance. And rho is essentially when interest rates are moving around, it's how the option pricing is going to react to the interest rate changes. Positive for calls, negative for puts. The rho value is going to be larger for longer dated options and a bit more negligible for like the weekly options. Strategists usually use this for long-term equity anticipation securities, which are leaps. And over the long frame, when interest rates actually start to move back and forth, this will become more significant. And we'll talk about this more in more advanced or the online webinars. But for right now, just know that gamma is the change in delta and rho has rates, R rates. Got it? So that's pretty simple. Implied volatility versus implied volatility rank. And I kind of briefly went over this a little bit, but I got ahead of myself, I guess, on my slides here. But as a reminder, implied volatility is the market's annualized expectation of a stock's move in price. So over the course of time, if something is very volatile, implied volatility may be a little bit less than a stock that is usually pretty steady as she goes and all of a sudden starts spiking, moving up and down dramatically. Implied volatility for that stock will have more of an impact. And the greater the fear and uncertainty in the market, like around earnings, the greater the premium is built into an option's price, which is what we talked about. You bought a call right before earnings and all of a sudden you were directionally correct, but after that news came out, you started seeing your premium go down despite the fact that you were right. That's due to this premium being pumped up due to the fear in the market. But this fear is often irrational and overstated. Actual observed move is typically less than the expected move. Thus, the implied tends to be overstated by about 77% of the time. So that's huge. And I'm going to get into this more in the webinars and the classrooms, how we can take advantage of some of these rules or some of these statistics. In theory, implied and actual volatility should remain centered around one standard deviation. If implied understates the actual move, premium buying is advantageous. But if the implied overstates the actual move, premium selling is advantageous. And I'm going to get into this more in my webinars as well, how we can take advantage of these statistics and when you should be selling and when you should be buying. The risk and rewards is what I'm going to go over now of call buyers and call sellers. Call buyers want the price to rise and implied volatility to rise in as short a time as possible to limit time decay. Now, talking about the earnings, this isn't necessarily the time to be the call buyer because the implied volatility is going to dramatically decrease after the results. So that's where we're going to see that compression of volatility. But if there was something that was not expected to come out and all of a sudden this call dramatically moves up or down, say for instance all of a sudden Microsoft is getting bought by Apple, then you'd see major moves in those stocks, and that wouldn't be necessarily priced into those stocks through volatility. And you want to limit time decay for call buyers. Like I said, the closer we get to expiration, especially within 30 days, you're going to see those calls rapidly decrease. And put buyers want the price to fall and implied volatility to rise in as short a time as possible. So you want that stock to really fall out of bed quickly after buying this so that you don't get your price premium decaying very quickly. Call sellers want the price to fall or stay flat, implied volatility to fall, and the time to pass, since time decay will be our friend in those situations. So I did briefly mention at the very beginning of this that a call seller is either bearish or market neutral. This is what I'm talking about. If you're market neutral, what you're going to see is time decay, that's theta, eat away at the premium, which means that you're making money, and the volatility to fall. So as volatility falls, that price will also compress. Put sellers want the price to either rise or implied volatility to fall and time to pass. So if the price is starting to rise on the underlying security when we're a put seller, we're going to start to see that go further out of the money and implied volatility to fall. So if it's a steady as she goes, slow rise, or just a flat line in that stock, volatility is going to fall as it flatlines. And as the time passes and we get closer to expiration, that is really going to start falling off the cliff. What can happen? Well, you can buy a call and the underlying goes up, but implied volatility goes down. And time decay eats away at your premium. So you lose. And that's the story I talked about with buying a call right before earnings. These are your risks. You buy a put and the underlying falls, but implied volatility goes down too, because it's just a slow creeping down. And we bought this right before expiration, and time decay eats away at our premium. So you end up losing. You sell a call or a put and the underlying stays flat, but implied volatility goes up, producing losses. Time decay will reduce these losses sometimes, especially if you're closer to expiration, but there could all of a sudden be some rumblings about a buyout, or some rumblings about news that could be being released soon, or there's going to be something bad in the earnings report. So you're going to start to see implied volatility start to spike, and you'll start to see those prices go against you, despite the fact that you're directionally correct.
Can take control and push this up, or the bears take control and push this down to the 1400 level. That's what's going to be setting up for this week. All right, you can't take that. Take it easy. The options over in the beans are just going crazy, and the edamame pit, as I've been saying on Twitter, everybody gets a big kick about that because the city kids here don't know what soybeans are. They call it edamame. They know what it is. All right, take that. Anyway, that's all I got for you today. If you can't take that, take it easy. Yeah.
Found a city. Just to prove our point, step in here, our escort. You did not know what edamame was.
Well, I didn't know they were soybeans.
See, there we have it.
You are a master, Wolfman. You are the man.